Dallas, Texas, 1979. Nelson Bunker Hunt is the richest private citizen in the world. His father, H.L. Hunt, discovered oil in East Texas in 1930 and built a fortune so large that Nelson and his brothers inherited more money than most countries will see in a decade. Bunker, as everyone calls him, is not a subtle man. He is large, loud, deeply religious, and possessed of a conviction that paper money is worthless and that the United States government, through inflation, is systematically stealing the savings of every American who trusts its currency. He has decided to do something about it. His solution is silver, not a little silver, not the hedging position of a cautious investor managing currency risk. Bunker Hunt's solution is to buy silver until he owns enough of it that the price cannot move without his permission. He wants to corner the market. He wants to hold in his hands the one commodity that paper money cannot replicate, that governments cannot print, that inflation cannot dissolve. He wants to own silver the way his father owned oil, completely, totally, and on terms that nobody else gets to set. What follows is one of the most extraordinary acts of individual financial hubris in the 20th century, a scheme so large that it destabilizes global commodity markets, brings several major Wall Street brokerages to the edge of bankruptcy, triggers an emergency intervention by the Federal Reserve, and ends with Bunker Hunt losing more than $1 billion in a single day. He was trying to protect his wealth from a corrupt financial system. He became the financial system's most spectacular victim. Bunker Hunt's conviction about silver is not irrational on its face. It is the product of a specific reading of monetary history that has genuine intellectual substance, even if the conclusion he draws from it is catastrophically overscaled. The United States abandoned the gold standard in 1971 when President Nixon ended the Bretton Woods system's guarantee that dollars could be exchanged for gold at a fixed rate. From that moment, the dollar became a fiat currency, backed not by physical metal, but by the full faith and credit of the United States government, which is to say, backed by nothing except the government's continued ability to tax its citizens and the world's continued willingness to accept dollars in payment for goods. The inflation that follows is severe. Between 1971 and 1979, the dollar loses approximately half its purchasing power. The price of goods that cost $1 in 1971 costs $2 by 1979. Interest rates are climbing toward 20% as the Federal Reserve under Paul Volcker attempts to break inflationary expectations with the blunt instrument of making money extremely expensive to borrow. The American economy is experiencing stagflation, simultaneous high inflation and high unemployment, a combination that standard Keynesian economics insists cannot happen and is therefore having considerable difficulty explaining or addressing. In this environment, hard assets, gold, silver, real estate, oil, are the refuge of investors who do not trust the government's ability to maintain the value of paper currency. Bunker Hunt is not alone in this conviction. He is merely more extreme in his response to it than anyone else alive. Silver has a specific appeal beyond its monetary history as a precious metal. It is an industrial commodity, used in photography, electronics, and a dozen industrial processes whose demand is structural rather than speculative. This means that silver has a floor of genuine utility, below which its price cannot fall regardless of financial conditions. It also means that the total above-ground stock of silver is finite and known, that production from mines adds to it slowly, and that any actor accumulating silver aggressively will eventually run into the physical limits of how much silver actually exists in a form that can be delivered. Bunker Hunt is betting that the supply is smaller than the world thinks, and the demand is larger than the world prices. He may be right about this as an investment thesis. He is catastrophically wrong about the scale at which he can act on it without destroying the very market he is trying to profit from. The buying begins in 1973. Bunker Hunt and his brother Herbert start purchasing silver futures contracts on the Chicago Board of Trade and the New York Commodity Exchange. Futures contracts are agreements to buy silver at a specified price on a specified future date, a standard instrument for producers who want to lock in prices and speculators who want to bet on price movements. The Hunt brothers' futures positions grow rapidly. By 1974, they hold contracts representing approximately 55 million ounces of silver, a staggering position in a market where total annual mine production is approximately 250 million ounces globally. They are not trading silver, they are accumulating it. The Commodity Futures Trading Commission, the federal regulator responsible for oversight of commodity markets, notices. In 1974, the regulator moves to impose position limits that would prevent any single trader from holding silver futures beyond a specified maximum. The Hunt brothers respond by converting their futures positions into physical silver, actual bars and coins, 90-day silver certificates, anything that represents the physical metal rather than a paper contract. They begin taking delivery, physically receiving the silver they have contracted to buy, rather than settling the contracts in cash as most futures speculators do. This is unusual. Futures markets are designed for price discovery and hedging, not physical accumulation. A trader who takes delivery is not playing the game the market is designed for. The Hunt brothers are not playing the game. They are removing silver from the market entirely, taking it out of the supply chain that industrial users and other investors depend on, and storing it in vaults in Dallas, in Switzerland, in wherever they can find space for tens of millions of ounces of physical metal. The logistical operation this requires is itself remarkable. Moving physical silver in the quantities the Hunts are accumulating means hiring armored transport companies, leasing vault space across multiple countries, coordinating with refineries to accept delivery in standardized bar form, and managing an inventory of physical metal that is growing faster than the infrastructure to store it can keep pace. At one point, the Hunts charter aircraft specifically to fly silver from New York to Switzerland because the vault space available in the United States is insufficient for the volume they are accumulating. The scale of the physical operation, the sheer tonnage of metal moving around the world at their direction, is a signal that anyone watching carefully should have read as a warning. Most people are not watching carefully. By 1979, the Hunt brothers and a group of Saudi and Kuwaiti investors they have recruited, the International Metals Investment Company, a partnership structured specifically to pool resources for silver accumulation, hold approximately 100 million ounces of physical silver plus futures contracts, representing an additional 150 million ounces. Total global silver production in 1979 is approximately 260 million ounces. The Hunt brothers and their partners effectively control a position equivalent to nearly the entire world's annual silver production. The price reflects this. Silver in 1979 begins the year at approximately $6 per ounce. By September, it is at $17. By December, it is at $30. On January 17th, 1980, it reaches $50 per ounce, an increase of more than 700% in 12 months. The price of silver at $50 per ounce in January 1980 is not simply a number in a commodity report. It is a physical reality that cascades through every corner of the American economy in ways that most people who lived through it remember even if they cannot explain the mechanism. American households begin melting their silverware. The calculation is simple. A set of sterling silver cutlery purchased in 1960 for a few $100s is now worth thousands at spot price. Dental silver, the amalgam used in fillings, is suddenly worth extracting. Photographic film, which uses silver in its emulsion, becomes prohibitively expensive at the new price, threatening the photography and printing industries. Coin dealers are overwhelmed by people bringing in silver coins, dimes, quarters, and half-dollars minted before 1965, when American coinage still contained 90% silver, to melt for their metal value. The industrial users of silver, electronics manufacturers, medical equipment producers, the photography industry, are paying spot prices for a commodity that has increased sevenfold in a year, with no corresponding change in their customers' ability to pay higher prices for finished goods. Their margins are being destroyed. Their inventory assumptions are worthless. They are calling their commodity brokers and their bankers in states of controlled panic. The brokerages that have extended credit to the Hunt brothers and their partners for their futures positions are watching the mathematics of their exposure with increasing alarm. Futures trading operates on margin. The trader posts a fraction of the total contract value as collateral and borrows the rest. As silver prices rise, the Hunt brothers' paper profits are enormous. But the margin calls, the additional collateral required as prices move, are also enormous. Batch, Merrill Lynch, and other brokerages that have lent the Hunts money against their silver positions are sitting on credit exposures that dwarf their capital bases. The Federal Reserve is watching all of this. Its primary concern in early 1980 is not the silver market per se. Its primary concern is the possibility that the failure of a major brokerage firm, overwhelmed by losses on silver-related lending, could trigger a cascade of bank failures comparable to what the Fed has spent 50 years building regulatory structures to prevent. The Commodity Exchanges Act in January 1980. The Chicago Board of Trade and the COMEX Exchange in New York changed their rules. Specifically, they moved to restrict the purchase of new silver futures contracts, permitting traders to close existing positions but not open new ones. The rule is called Silver Rule 7, and it is the most consequential regulatory intervention in commodity market history. The effect is immediate and devastating. With new buying restricted, the only direction prices can move is down. Holders of silver futures who cannot roll their positions forward into new contracts must sell, and they must sell into a market where the new rule has removed the buyers. Silver, which has been held up by the continuous accumulation of the Hunt brothers and their partners, has no floor once that accumulation stops. The price begins to fall. Slowly at first, then faster, then in the kind of self-reinforcing collapse that markets produce when confidence breaks simultaneously across thousands of traders making the same calculation at the same moment. On March 27, 1980, the day that becomes known as Silver Thursday, silver falls to approximately $10 per ounce. From a high of $50 in January, the price has collapsed by 80% in 10 weeks. The Hunt brothers, who have borrowed heavily against their silver holdings, receive margin calls they cannot meet. Their brokerages, which have extended credit against silver collateral that is now worth a fraction of the loan value, face losses that threaten their solvency. The numbers involved are staggering. The Hunt brothers owe approximately $1.7 billion in margin calls and loans. They have silver holdings worth considerably less than that at current prices. They are, in the technical sense of the word, bankrupt. Their liabilities exceed their liquid assets by a margin that no amount of oil money can easily cover. The Federal Reserve does not allow the Hunt brothers to simply fail. Not because it wants to protect them. Paul Volcker has no particular sympathy for Texas oil billionaires who have destabilized commodity markets through speculative excess. The Fed's concern is systemic. Several of the brokerages and banks that have extended credit to the Hunts are genuinely threatened by the scale of the losses. A disorderly Hunt failure could pull them under, and a disorderly brokerage failure in March 1980, in the middle of an already fragile economy with 20% interest rates and double-digit inflation, could produce the kind of financial cascade that the Fed exists to prevent. The solution is a coordinated private bailout organized under Federal Reserve supervision. A consortium of 13 banks, led by First National Bank of Chicago, extends the Hunt brothers a loan of $1.1 billion. At the time, the largest private credit facility in American banking history, secured against their silver holdings, their oil properties, and virtually every other asset the family possesses. The terms are punishing. The Hunts must sell their silver systematically to repay the loan. They must submit to financial supervision. They must agree to a managed liquidation of the position that destroyed them. The Fed's role is not to lend money, but to ensure that the consortium holds together, that none of the 13 banks loses confidence and pulls out, which would destabilize the others and prevent the orderly resolution the situation requires. It is crisis management of a kind that the Fed was created to provide, and it works in the narrow sense that no major financial institution fails as a direct result of the Hunt silver scheme. The aftermath is long and financially catastrophic for the Hunt family. The $1.1 billion bailout loan is not the end of their obligations. The total losses from the silver scheme, the collapsed positions, the margin calls, the litigation, eventually consume several $billion of Hunt family wealth. Bunker Hunt files for personal bankruptcy in 1988, listing debts of approximately $2.5 billion against assets insufficient to cover them. The man who was once described as possibly the wealthiest private individual in the world is legally insolvent. The legal consequences extend beyond bankruptcy. The Hunt brothers are sued by the Commodity Futures Trading Commission, by individual investors who lost money when the silver price collapsed, and by Peruvian silver producers who alleged that the price manipulation had damaged their industry. A 1988 civil lawsuit, filed by a Peruvian silver mining company, results in a jury verdict against the Hunts of $134 million in compensatory damages and additional penalties. The jury finds explicitly that the Hunt brothers had conspired to corner and manipulate the silver market. The broader economic consequences of the silver episode are harder to quantify, but real. The photography industry, which had been planning capital investments based on silver prices that were stable, faces years of disruption from the price volatility. Small investors who bought silver at or near the peak, persuaded by the price momentum that $40 silver was going to $60, lose substantial portions of their savings when the collapse arrives. The commodity exchanges, embarrassed by the regulatory failure that allowed the position to build to its extreme size, implement position limits and margin rules that persist to the present day. Bunker Hunt's stated motivation for the silver scheme is protection against inflation, specifically protection against the loss of purchasing power that fiat currency produces over time. The irony is that the scheme produces precisely the outcome he was trying to avoid, at a far greater scale and speed than inflation alone would have achieved. In the years between 1973 and 1980, Hunt family silver holdings that were bought at an average price of perhaps $10 per ounce rise to $50 per ounce, a paper profit of hundreds of millions of dollars that exists for a few weeks in January 1980 before the collapse begins. The profit is never realized because the position is too large to exit at peak prices without causing the very collapse it is trying to avoid. A position large enough to corner a market is, by definition, a position too large to sell without destroying the price it depends on. The Federal Reserve that Bunker Hunt despised, the institution he considered complicit in the inflation that was destroying the value of paper money, is the institution that organizes the bailout that prevents his failure from destroying the financial system. The government he distrusted saves him from the consequences of the plan he designed to save himself from the government. The free market he believed in fails him at the precise moment he needs it most, because the free market cannot absorb a position of this size without breaking. He was not wrong that inflation destroys wealth. He was catastrophically wrong about the scale at which one man can act on that insight without becoming the crisis he was trying to escape. Silver today trades at prices far below the 1980 peak, adjusted for inflation. The photographs taken in 1980 with expensive silver-based film are fading. The silverware melted for spot price in January is gone. The $1.1 billion bailout is a line in financial history textbooks. And Bunker Hunt, who wanted to hold something real against the unreality of paper money, held silver worth $50 an ounce for about 3 weeks, and spent the next decade paying for it.